My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save you a little money. My job is not just to put in context, but explain the stuff, try to be entertaining. It is Friday. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Tough day. You know that 10 days ago, there was this deal coming for a company that looked like the hottest thing since the invention of the steam engine. People were talking about it as the way to invest in the greatest industrial revolution since the canal, the railroads, even the loom. Fast forward to today, and what's the single most disappointing stock in the entire market? One that's nasty, debt-laden business with diminishing clients and a product that's losing value as I speak. They're the exact same company. It's called CoreWeave. This AI infrastructure IPO set the tone today, a day where the Dow tumbled 716 points, S&P plunged 1.97%, and the Nasdaq plummeted 2.7%. CoreWeave was originally supposed to come public at 47 to 55. That was the range. But last night they downsized the deal and they cut the offer price to $40 because of weaker than expected demand. The stock opened $1 below that level this afternoon before managing to close exactly at the $40 place. How ironic. You know that last week this deal could have come at 40 and opened at 50 and go higher still. Incredible mood swings right now. And by the way, mood swings are not good for good investing. Yes, this company, CoreWeave, is the glue that holds the data center together. It's become toxic because of a person with a lot of money, Joe Tsai from Alibaba in China, seems to be questioning the data center's cost and wondering if a bubble's on the horizon. Microsoft, too, is a problem, rumored to be scaling back some data center commitments, but we don't even know enough to make a decision about that. Not that it mattered in a shoot first and then don't even bother to ask questions environment like we're in now. Now, if you're at CoreWeave and you thrive on the need for more data centers, you're watching what the market thinks is peak demand. The action today says there's nowhere to go but down. CoreWeave obviously doesn't believe that, but the market decided that NVIDIA's GTC conference last week, remember we went out there, marked the top of the entire industry. And the CoreWeave deal with its radically downsized offering was just confirmation. When you couple that with the tariffs orchestrated by the President of the United States, you got a stock market that feels like a nuclear winter. In this kind of environment, you don't need a weatherman to know which way the wind blows. Today, the wind blew the radioactivity from the CoreWeave deal and the auto tariffs and sent it right in your face. Can the fallout be wiped off before your portfolio is totally irradiated? You know what? I think we'll find out next week once the radiation clears, but don't get too excited. I'm not going to give you a real upbeat thing going here, even though it's supposed to be a nice day tomorrow in the East. You're not going to feel pretty good after I read this. I'm just trying to tell you the straight stuff. Now, we don't have a lot of earnings next week, but we do have two gigantic events. And first, Wednesday, that's what the president's calling Liberation Day, the day when he tells us that what the new tariff regime will look like, liberate ourselves from our trading enemies or whatever. And then second, Friday, Labor Department's non-farm payroll figures for March. These are both really, really big days. Everything else is a little tiny, but we're going to deal with it anyway. Both of those have the potential to turn this market around. One, because it will be great when we are past it, and the other because people think the inflation is about to rage. And who knows, maybe something happens that puts CoreWeave back in the market's good graces. The stock did finish where it was priced, although it did trade a couple of dollars lower intraday. We will be speaking to the CEO of CoreWeave later tonight, so we'll find out whether we can do some buying or take a page from those stock sages Fleetwood Mac, pick up the pieces and go home. My history of studying these things says the stock does not act well for the next couple of weeks. That's been the process. I've seen it over and over again, been involved in IPOs, been in the syndicate desk. That's my knowledge. Frankly, I'm not sanguine. For weeks, I've been telling members of the CNBC Investing Club that tech's suspect. We haven't bought anything until today, and nothing at all in tech, because we see that the market's turned against artificial intelligence, robots, autonomous driving. We have eyes. It's even turned against the chatbots, and it's like nothing's going to come back. Even though you'll hear of an alpha tonight called Otter, it's a private company, and you're going to say, wow, I wish that the data center and people talk a little bit better about AI because it's so incredible, or so it seems. What happens going forward? Look, I think there's some good news here. First, there won't be another CoreWeave deal next week. Second, after Wednesday, there probably won't be any new news on tariffs on top of the news on tariffs. Now, those are the two reasons why you can't afford to leave this market right now, even though I know it would just feel so great to sell everything. I mean, I just said get out now. Probably half of you would think, thank God he relieved us from our chains of anger and sadness. But what's on the calendar next week other than Liberation Day, where we find out exactly how awful the penalty to our commerce will be, at least in the short term? No one is going to celebrate that day other than to say that it's over. On Monday, we hear from PVH. That's the apparel company behind Calvin Klein and Tommy Hilfiger. It used to be a very hot stock at one point. We've become so used to disappointments in retail, though, that our eyes will glaze over when we see how bad these numbers might be. Understand that the estimates here have been consistently cut for PVH, and there's still little hope that it will beat the numbers. The numbers. All I can say is fingers are crossed. Now, Tuesday, April Fool's, and today made you feel, well, kind of like a real fool if you bought some stocks. Let's hope it isn't a prelude. If you're a bull, you want people to be prepared for everything the president can throw at the worldwide system of free trade. You have to believe that there will be no one left who thinks the tariffs won't be worse than Smoot-Hawley. That was a horrendous set of tariffs that helped usher in the Great Depression. The bulls want people to wake up from the nightmare that is CoreWeave and wish they bought it. I say don't hold your breath. And don't expect the steal to open the IPO floodgates either. We should all be glad that they were able to get it done at all. The market's beginning to believe that the president will stop at nothing to make his points on trade. And he won't change his mind until all our trading partners are brought to heel. I believe that. And then maybe we bounce. I think some people might say that's too dire, though. As I see it, we're getting closer to the moment where President Trump recognizes the beating that people are actually taking the stock market. But it'll take time to get there because stocks have run so much in the last decade. If he I don't know, if maybe the decline gets bad enough, he'll do something. I bet he'll ease up on the tariff rhetoric. We aren't there yet, though. This is a bad place to be, but it is not horrendous. That's the best I can say about it. Now, there's some corporate news adjacent to Liberation Day. RH reports on Wednesday at the close. That's the old Restoration Hardware has fallen from 457 down to 236, a sickening decline, but not unlike many other retailers. I'd say wait for the bounce. I'm not really I don't know. It's too hard. How about that? It's just too hard. Events out of Washington weigh too heavily on the market to make that kind of bet. And with this tape, it does feel more like a bet than an investment. Thursday's quiet on the Washington front, but it's a good prelude to the beginning of earnings season. ConAgra reports, okay, and the last time we heard from this packaged food company was a bit dispiriting. One look at that yield north of 5% tells you that something's very awry here. And we also have ConAgra Spawn, Lamb Weston, the frozen potato company, which is trying to bounce, to which I say, so is CoreWeave. Finally, on Friday, we get the Labor Department non-farm payroll report. Let's speak about this. Now, in light of the very inflationary tariffs, and tariffs are immediately inflationary, the bulls have to hope this number shows slow job growth and no wage growth. Given this market's mood, I think that anything that deviates from that Panglossian scenario will trigger not just talks of stagflation, but definitive chatter about a bear market. That's where we are, okay? People are going to start talking next week that we are in a bear market, and it's not going to be any more about a correction. It's going to be the absolute bear, which brings me to the fatal question. Is it too late to get out, or should we start thinking of buying on weakness? Now, I can tell you that a couple of real bad days does not a bear make. It's a nasty run. Doesn't seem like it's over. So why not do this? Take the other side of the trade. If you have some cash on the sidelines, I'd actually put a small amount of money to work into the abyss of Tuesday, betting that things are going to be too negative for what we see on Wednesday. Then you can put more money to work on Friday if we get knocked down by an overheated labor report. The bottom line, it's not the end of the world. It just feels that way. Okay, let's go to Martin in Florida, please. Martin.
Booyah, Mr. Cramer. How are you today?
Long day, but I feel for everybody who owns a lot of stocks. How are you doing today?
I'm doing fine. I'm here in the Sunshine State enjoying the beautiful weather. My question is on Nike. How do you feel about Nike in the short term and the long term?
You know, it's funny. I was talking to my trainer today, Jim, and we were both saying that Nike really has lost its edge and that on is the way to go, on. And I think the stock's correctly reflecting that analysis. I know they're trying to turn, and that's terrific. But, the other companies aren't standing still while they try to turn. And that's the big difference from all the other times I've seen Nike stumble. Look, a few terrible days does not necessarily make a bear market. It's not the end of the world. It just kind of feels like it. On today, I've got the CEO of CoreWeave, fresh off the AI company's debut to the public market. This is the only time we'll be on other than when he was on in the morning. Don't miss this. I thought it was funny. Don't miss this post-IPO check-in. Then can you call on the telecom stocks despite this tough tape? I'm giving you a name to watch, and it's pretty famous. And by the way, I'm going to sit down with a company called Otter AI to hear how this private player is innovating the virtual meeting room. It's called Otter because otters are actually smart. Who knew? Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Today, we got the widely anticipated debut of CoreWeave. It's a company that's built a next-generation cloud platform for the AI era that we're in. I covered this story Wednesday night, but in the last 2 days, been some developments, and not all positive. But ultimately, the demand for the IPO wasn't there at the original deal size. Didn't mean they didn't get the deal done, though. Yesterday, CoreWeave cut the offer size from 49 million shares to 37.5 million shares, lowered the deal price to $40 in order to get the deal done. They ultimately raised $1.5 billion rather than $2.5 billion. But hey, at least they got it done, especially after today's developed into just another brutal tech-led sell-off. Shortly after 1 p.m., stock opened, trading at $39 below the offer price of $40. Did touch $37.50, but then bounced back, closed exactly at the offer price, $40. So is CoreWeave's tepid debut an opportunity for you? Which is a good reason why Wall Street lacked the enthusiasm at the higher price. How about we go straight to the source? We find out joining with Mike Intrater. He's the co-founder, chairman, and CEO of CoreWeave. Hey, Mike, thank you so much for coming on the show, and congratulations on the IPO.
Thank you so much. Today has been such an amazing day for us. I appreciate the opportunity to talk with you.
All right, so Mike, there are a lot of people joking around today. They were saying, did Intrater and those boys at CoreWeave cause the problem in the market, or was the market the reason why CoreWeave stock didn't shoot up higher? But you know what? Let's talk about the fact that 10 days ago, this market was hot, and then today, people think it's cold. The truth is, that's just not the way it is at all, is it?
No, listen, look, it was a really tough tape today. It's been a tough tape for the last, couple of weeks here. There's headwinds on the whole market, and there's definitely headwinds in the AI space. But look, stock comes out, it trades pretty tough, kind of ends up where we offered it. I feel like we did a good job. The banks did a good job kind of downsizing the offering and getting the price right so that we can come out into this market. And you hit it dead right. Like, for us, the key to this was getting into the public markets, offering our stock, and having the ability to be a public company, because that is transformative for our company.
Now, Mike, I'll tell you, one of the things that occurred to me all week, actually, was we're used to tech companies coming out with no debt. Why? Because the venture capitalists take stock. This did not come out that way, so a lot of the tech people said, my God, this has a lot of debt. In reality, the way you want to be able to do your business is to buy all the NVIDIA GPUs you can do and get that first mover advantage. And if you didn't take any debt down, where would your company be?
Yeah, look, the debt is the engine. It's the fuel for this company, right? We go out, we find great contracts with great counterparties that need massive scale computing to drive their business. And then we go ahead and we go back to our syndicate of lenders, and they give us the debt to stand up the clusters that will deliver revenue to the company. It really is matched. Whenever you see debt on our balance sheet, you're going to see an offsetting revenue contract that is larger.
Right. Now, there were a lot of people today who were saying, well, wait a second, these things depreciate rather quickly. And didn't Jensen Huang himself say in his keynote that he sure hopes that nobody buys the Grace Blackwell when the Vera Rubin comes in? There was a lot of joking about that, and I think people didn't realize that it actually was said in jest. Because, in fact, the Grace Blackwells will be worth something even 2 years from now. True?
Yeah, absolutely. He made the joke that he was the chief revenue destroyer, and I almost fell out of my seat. But look, at the end of the day, there's the narrative that was out there that these things depreciate so fast and will be supplanted by the next generation. But in truth, what we see from the contracts that we are actually able to execute, like the just under $12 billion contract that we executed with OpenAI last week, they executed that contract for 5 years with 2 one-year extensions. So it is a clear articulation by people who are putting up the money, that are buying these contracts, that they believe that this infrastructure will have retain value far into the future. And those same buyers will come back. They will buy new infrastructure. that is the most cutting edge for their next models. And then they'll take this earlier infrastructure and use it for other use cases in their company that requires really large bulk compute.
Excellent. Okay, so Mike, a week ago, people were saying, wow, NVIDIA really likes these guys. It's terrific. They have position in it. And the narrative changed today. It was like, oh, my God, NVIDIA's propping this thing up. I mean, they're way too close. They are way too close. So, again, something in between?
Yeah, look, people are going to put out whatever narrative they want. At the end of the day, NVIDIA has been an incredible partner for us. And we have been an incredible partner for them. We build fantastic infrastructure. We bring it to the market in its most performant configuration. We're able to deliver it quickly. We have wonderful software that allows people to use it to be able to drive their models. They understand our business deeply. They understand the debt in our business deeply. And they believe that it is a fantastic way about going and scaling infrastructure for all of these new consumers as the world goes through this AI revolution.
I know I found myself defending your company. I went out to one of your really beautiful, I got to tell you, I mean, incredibly hot, yes, but in actual hot reality, data centers. Yeah. And one of the things that people are really caught up in is the idea that two people, Joe Tsai, and then Joe Tsai said something about maybe a bubble, and then Microsoft actually didn't play. It's not really clear what they did, but backed away from buying even more. Those two somehow made people feel like that this whole operation is completely overvalued, and the emperor has no clothes. Again, I wonder whether the zeitgeist of the stock market didn't interfere with the company whose product is so far in demand with a moat that no one else can deliver because they don't know how to do what you do. And that was totally obscured today and yesterday.
Yeah, look, my theory here is that the market's going to take some time to kind of figure out exactly what we do and how we do it. But the compute that we deliver, the software that we deliver it on, it is a driver for performance. And that's really what will ultimately bring clients back to us again and again. The data center, I mean, I'm so glad you got a chance to go there. It's just an amazing operation. You get to see this infrastructure. It's like walking into the Death Star. It's incredible.
Yeah, it is. And I think that people don't understand that a data center, the more NVIDIA you have, the more you can do things that are wondrous and incredible. So perhaps you can explain what's the difference between a Pentium and a GPU?
Yeah. So look. First, on folks, kind of different narratives out there around demand for compute. I have a very simple way of thinking about this. I have clients. They come to me. They need compute. They want us to build bigger. They want us to build faster. There is absolutely no hesitation. I can sell every single piece of computing power that I can stand up within the data center infrastructure that I have. So to the extent that there are other folks seeing an air pocket in the data center space, that is not what my clients are telling me. It's not what their behavior is telling me. It's not what a $12 billion contract tells me. And so I'm pretty excited about that. As far as the difference between the clouds, the legacy clouds were built on CPUs, right? And when you want to drive artificial intelligence, you're really moving to a new computational intensive accelerator called a GPU, which is what NVIDIA has done such an extraordinary job driving into the market. And that infrastructure is really what is allowing the world to build artificial intelligence.
Now, one thing, and I got this from being in a data center, I wish everyone would go to a data center. One thing people don't realize, they break. Things break. And when things break, and you have downtime, well, you might as well just say, this is costing me tens of millions of dollars. I have to get it fixed immediately. Now, there are some companies that fix it faster than others. And CoreWeave, I am told over and over again, fixes it faster than anybody.
Yeah, that's absolutely true. Like, look, at the end of the day, the way that we built our cloud, the way that the value proposition for our cloud is, we have built this data center specifically to stand up parallelized computing, the GPU computing that allows for artificial intelligence. And when you build it that way, you make 1,000 architectural decisions that optimize specifically for that, which allows for observability down into the physical infrastructure. It allows for predictive analytics so that you know when to cordon off infrastructure that's about to break. We really do a great job at this company addressing downtime, making sure that all of our clients have access to the compute for as much time as physically possible. And it is a tremendous focus for our teams across the physical side as well as the logical side.
All right, last question, just be a little bit philosophic here. It's entirely possible that, yes, AI and compute are all peaking, but wouldn't that be almost impossible given the fact that we still don't have autonomous cars on the interstate and nobody has a robot at home and we've not been able to fix the warehouse issues yet? In other words, the infancy with which we find ourselves doesn't really jive with me with the end of the AI world as we know it.
Yeah, listen, I couldn't agree with you more. I think that, people are really kind of thinking about this in a very short time span. And the truth is this is a process that will go on for decades, right? The world is automating. It is moving towards artificial intelligence. It will integrate into every aspect of our life. And the truth is, we are going to be playing catch up with the computational power that's required to make that happen for years.
Well, I want to thank you for coming on. I know it's an emotional time. Your deal did get done. People who bought it at the low today made good money. People who bought on the deal are fine. And we must never forget that. Having brought a company public, I respect exactly what you accomplished. And I can't thank you enough for coming on a second time on CNBC. Michael Intrator, co-founder, chairman, CEO of CoreWeave, who also happens to be from New Jersey and not from Silicon Valley. Thank you, Michael, for coming on the show.
Thanks a lot. Appreciate it,
Absolutely. Mad Money's back into the break.
Coming up, has a consistent value trap transformed itself into a growth story? Cramer's plugging into what's moving AT&T higher. Next.
I know that many of you have been sick to your stomach from the roller coaster ride this stock market has been giving us in recent weeks, including, by the way, today's beatdown. And for now, this remains a very uncertain moment. A lot of potential negatives. And that's why I've spent the entire week looking through the best performers in the S&P 500 for the year, because these are the stocks that manage to hold up in a truly terrible environment. All right, tonight I've got one that I haven't been a fan of until very recently. Well, I'd say about last year and a half, and that's AT&T. Surprisingly, it's off to a great start for the year. It's up almost 24%. Now, doesn't that sound comforting versus the rest of your NASDAQ part of your portfolio? Every time I talk about the telco carriers, I always recommend T-Mobile. It's been a big winner, right? They've been running circles around AT&T and Verizon for years. But suddenly, AT&T's been making a name for itself as a safe haven in a tough market, and we don't have many of those. When investors feel like the environment's gotten really treacherous, they like to throw their money into something deemed safe. Telecom fits the safety criteria because it's more insulated from the cyclical nature of the economy. Things have to get pretty darn bad before you stop paying your cell phone bill, don't they? And also because these companies tend to pay pretty good dividends. But a safe industry with a fat dividend doesn't make you immune from turnover in this market. Just ask people invested in, AT&T for most of the past 2 decades. This stock was what you call a value trap for years, and anyone who chased after their seemingly juicy dividend yield was ultimately punished with a lower stock price. So what's changed then to allow AT&T to become a winner this year? Well, for starters, this is no longer the old AT&T that we think about. After spending years trying to diversify away from the phone business, which was ill-fated, by the way, they finally decided to stick with what they knew best, phone business. Back in September, AT&T told us they're selling the rest of their stake in DirecTV. What a disaster that was. And that comes on top of the Warner Brothers spinoff a few years ago. Doesn't hurt that the whole wireless business has gotten less competitive, and that's allowing all three of the major carriers to steadily raise prices. But the main reason AT&T stock got its mojo back is that management held an investor day in December, and they laid out a very clear roadmap with healthy growth expectations. It was a breath of fresh air for investors who might have bought this stock for years, but for the dividend, but have seen those quarterly payouts cut, with the remaining payments more like just kind of canceled out whatever gain you had. So in other words, let's say you have like a 4 to 5% dividend and the stock goes down 10%. Well, you know what? So what about the dividend, right? If AT&T can snap out of its funk like it's been doing this year, then owning it could be very rewarding. The company's targeting more than $40 billion to be returned to shareholders through 2027. Now, half that's going to be with dividend. It currently yields a little less than 4%. And half it's going to be buybacks. They're basically planning to repurchase 10% of the share count. And that's a huge sign of confidence, isn't it? How does AT&T manage to bring back growth? Well, they're focused on fiber broadband, the one area where they're the market leader. Their growth target for this part of the business includes a fiber passings target, or the amount of homes and businesses that their fiber optic network physically passes and could potentially serve. They see their company-owned locations hitting 45 million by 2029. This means AT&T is baking in an assumption of roughly 3 million new locations per year. Imagine believes the number can reach 50 million locations total through its access partnerships. That's going to be very strong. The fiber build-out is important because these investments generate higher average revenue per user, and also give the company more opportunities to bundle their services. Now, this fiber build-out is going to be real expensive. They're planning $22 billion of capital investments annually through 2027. But despite these higher costs, management still sees the opportunity for margin expansion as this fiber business steadily becomes a larger slice of the pie, while the legacy copper business slowly declines. Now, I didn't imagine I'd be spending my Friday afternoon talking about copper decommissioning, but it is an important part to the story. See, the fiber business has 35% lower operating costs than the legacy copper wire business. So it's encouraging to hear CEO John Stankey say on the earnings call that, quote, the new administration is interested in finding approaches to scale these more rapidly and have an appropriate way to clear them through faster, end quote. For context, it's part of the FCC's job to ensure that, quote, critical communications infrastructure, end quote, isn't unfairly cut off, leaving low-income or rural communities without service. Stankey is suggesting that the administration is willing to work with AT&T and its compadres to ensure that the replacement process goes as fast as possible by reducing red tape. That would be something. Hey, speaking of Washington, it doesn't hurt that AT&T is mostly a domestic telco business, which means it has extremely limited tariff exposure, thank heavens. You don't need to worry about the trade policy if you own this one. I think companies without trade exposure are going to increasingly get a very big premium over those that do. And this was all part of the revaluation. Management's also optimistic that the current administration will be successful in extending some tax incentives that are set to expire this year. This includes the 100% bonus depreciation giveaway that gave companies like AT&T the ability to immediately deduct the full cost of assets like network infrastructure equipment. It's important to remember that these tax breaks were from the tax reform package that Trump passed in 2017. With the GOP in control of Congress, they can easily, I believe, extend any part of it that might be expiring. So what else does AT&T have going for it? At the end of January, they reported an excellent quarter, good subscription numbers, strong free cash flow growth, and management reiterated their previous guidance. That might seem like a low bar, but in a negative market like this one, I think a little consistency goes a long way. But the most recent results indicate that AT&T's really turned the corner here. The company also spent a lot of time on the last conference call talking about the AT&T guarantee, where they'll give you a prorated refund for any service outages. They'll even give you a reward card if you have to spend more than 5 minutes waiting for technical support and you didn't receive a call back. I don't know. That could be valuable. So while the value here may not be as obvious as let's say, a Chili's 3 for me, management still sees this as a differentiator for the company. As CEO John Stankey said on the last conference call, quote, where we have fiber, we win. We win because it's a better product, end quote. So here's the bottom line here. AT&T's mainly roared this year as a higher yielding flight to safety trade. But there are also some company-specific positives as the company's gone a long way to turn itself around. At the very least, the stock's no longer a value trap, which is why it's been working this year and why I expect it to keep working as long as people are worried about the state of the economy. I want to go to Michael in Tennessee, please. Michael.
Jim,
Michael.
Just wanted your advice on a long-term play. This company has partnerships in place with major telecom providers like AT&T, Verizon, and Vodafone. What do you see as the biggest challenges in scaling this technology, and how does this company overcome them? The company is ASTS. Thank you.
Okay. All right. Thank you. The biggest problem is that they've got a hideous balance sheet. And I don't like hideous balance sheets. What has to happen is I think they should take on a partner. I do think that they've got a very interesting way to look. It's a good telco company partner. But what really matters to me is they've got to either start making money or get someone to give them some money. Right now, I think you're too up in the air in this particular stock market. As long as people are worried about the state of the economy, I think AT&T can continue to be a stock to watch, maybe even buy. Now, with much more Mad Money ahead, outside of this tech-led sell-off, I'm getting a better sense of the generative AI space with a private player by the name of Otter AI. Otter's are real smart. Take my word for it. Then I'm taking a step back from today's action and giving you my take on the market's road ahead. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. I know there's a lot of skepticism all of a sudden surrounding artificial intelligence after still one more hideous tech-led sell-off today. I've been through so many of these tech-led sell-offs since 80. Give me a break. But after going to NVIDIA's GTC last week, I remain a believer. It's just hard for most people to appreciate what's working in the space because it's generally for the enterprise, not for the consumer. That's why I like to highlight some of the most interesting stories in the space because it's very edifying. Take Otter AI, and that's Otter.ai, okay? That's a fast-growing, privately held company. It describes itself as, quote, the leading AI meeting agent empowering businesses to unlock the value of their meetings, end quote. What does that mean in practice? Look, we use Otter AI's technology here at CNBC. Their software listens to your meetings, producing real-time transcripts with notes, summaries, action items, and even some customized insights that I love. Nobody needs to take notes, so everybody can focus on the task at hand. This is genuinely valuable. I wish I had this when I was growing up. Earlier this week, Otter AI hit $100 million in annual recurring revenue. ARR is really important. Pretty remarkable when you consider they have less than 200 employees. So let's dig deeper with Sam Liang, who is the co-founder and CEO of Otter AI. Sam, thank you for coming to Mad Money.
Thank you. Thank you for having me here.
Okay, so I have screamed at my staff, get me this transcript. Find out where it says it. Little did I know I was screaming actually at you. I was screaming at Otter. How did you so quickly become the go-to for so many people trying to figure out what was said, where, and how?
Well, I've been working on this for a number of years. We started in 2016 before AI became a buzzword. Right. But we built the best speech recognition, the best conversational AI, and then we launched our first app in 2016. We barely had any revenue at that time. So within 5 years, we grew from 1 million to 100 million now. This is just a good milestone. We want to grow to $1 billion revenue in a few years. So we see that people talk a lot.
I talk a whole lot.
Meetings are a huge time drain in enterprises. On average, knowledge workers spend at least 30% of their time in meetings, and if you're a manager, you spend 50%, 70% of your time in meetings, right? So now with the Otter AI agent, which we're announcing this week, Otter can not only take meeting notes silently, Otter can start participating in meetings.
So Otter can be me. I may have to be in another place, but Otter can be me?
Absolutely, absolutely. You can already send Otter to multiple meetings at the same time, assuming you're
double booked. So this is maybe
booked.
one of the most productivity-enhancing software, I don't even want to call it software, I don't know, AI, that I've ever heard about.
Yeah, Otter is an AI-powered software application. It can join your online meetings, or you can use Otter on your mobile device for in-person meetings as well.
And I've seen somehow, and I'm going to ask you how this is, it seems to capture let's use the word spirit of the meeting.
It can capture the spirit of the meeting. It can capture what everyone said, but then the AI can extract insights out of the unstructured voice data.
Well, it would seem to me they're saying this is not some automated transcript. It's kind of a living, breathing document where if people are cross with each other, if people seem to be challenging each other, it actually detects that.
It can detect that. It can detect the sentiment, who agrees with whom, who disagree. Are people angry, or are they happy with each other? What are the decisions made? What are the action items to follow up with? AI it becoming a co-worker in your meetings.
A co-worker. I think that's a great way to put it. How do I query it? How do I interrogate it?
Yeah, you can already query Otter using text-based chat, but starting this week, you can start talking to Otter in meetings. You can say, "Hey, Otter, what's our revenue last quarter? Tell me the user request from this customer."
Well, wasn't this what I thought Copilot was going to do this? I don't think it's doing it yet.
I don't think they're doing it. The Otter AI agent we just launched this week can talk to you in real-time meetings. Can pull data from your database and speak up in meetings.
You have to make money. I know you've got a free version. You also have a freemium model, so to speak. So what would free version versus what I could ultimately get if I paid, what, $20 a month?
There's a pro version. It's less than $10 per month.
Really?
The business version is about $20 a month. Okay. Of course, if you are enterprise, we can talk about enterprise contracts. The new AI meeting agent is available in the business tier first, and later we'll move it to the other tiers.
Now, I noticed this. I know we're truncated here, but I mean, I thought that Zoom had something like this, but Zoom does not. Correct?
Zoom doesn't have this, and nobody is having this a new AI meeting agent capability that can speak up in meetings. Not only can speak up, it can actually take some action. You can ask Otter to create an action item, schedule a meeting, draft an email for you while you are still talking in the meetings.
Well, that's incredible. I wish Alexa knew something. You know, like I go home and I asked for Beethoven's Fourth, and I got some sort of Mozart. I mean, you wouldn't do that to me, would you?
Gradually, Otter can do a lot more. I think so. Allows you to conduct business at the speed of talk. You just talk to the agent.
Talk. I'm going to use that tonight at dinner. At Sam Liang. Now, this company's private. We joke a little more when it's private because we don't have any numbers, but he's the co-founder and CEO of Otter AI. We use it at the office. It's quite exciting, sir, what you've developed. Congratulations.
Thank you. Thank you.
And money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. Start with the lightning round. That's our graphical really same stock started by buy sell. So the core stock questions. That's how much staff is the plan is down. And then the lightning round is over. Are you ready? Ski daddy. Time for the lightning round. I'm going to start with Ganesh in New York. New Jersey. Ganesh.
Hi, Jim. How are you? I enjoy watching your show.
Thank you, Ganesh. Good to hear from you. What's going on?
I love your subject matter expertise and deep knowledge. I am a long-term investor, and I have a holding of CE. And
the CE is they've struggled. They have struggled, and I have to tell you, I'm not happy with how they're doing, and I can't long-term or short-term hide that. I'm just not happy with how they're doing. I'm sorry. Let's go to Ike in Georgia. Ike.
Booyah, Jim.
Booyah, Ike. What's happening?
Man, we just hanging in there trying to crawl through this wall of worry.
Good attitude.
Thank you for all you do for us little guys. All the
thank you, buddy. Thank you.
How to make money, how to keep money.
Well, both are both valiant goals. How can I help you make and keep?
Yes, right. AppLovin, man.
AppLovin is very controversial. Okay, so let me just dispel one thing. When you have Craig Billies, who's the CEO of Win, as the head of the audit committee and also the lead director of AppLovin, then I'm going to believe the financials. Is the stock expensive? It did have a great fourth quarter. Should someone else come in and take away their gross margins? I would like to go into that business and take them away. That company's making, I'd say, over-earning is the biggest problem I have with AppLovin. Let's go to Peter in Pennsylvania. Peter.
Booyah, Jim. I'm a club member and a long-time viewer from way back when before you were Jimmy Chill. Jim, what do you think?
It was the medicine. It was the medicine. Go ahead.
Jim, what do you think of Core Civics?
I'm surprised the stock has kind of come back down here. I think it had a huge move, and then it's just kind of resting. I think the stock is ready to move again. Okay, let's go to Jake in New York. Jake.
Booyah, Jimmy Chill.
Oh, man, what's shaking with you?
It's Friday. We got some March Madness. I'm assuming you're watching.
I get it when I can sneak it when my wife isn't constantly insisting on seeing Reacher, and she's not. By the way, watch it with the sound off. What's that about?
No idea. But you did some homework. You thought this stock was a good spec, and that was at $10. We're at $21.95. Okay. Analyst Day coming up on Tuesday, first Analyst Day. I'd like to know what you think about SRAD Sport Radar.
I think Sportradar is a very interesting, intriguing stock. Now, but remember, I also like Flutter. I like DraftKings. I like the whole space, and that is one very important part of the whole space. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's shining a light through today's tape and telling investors why they need to stay the course. Next.
Despair is not a strategy. Fear is not a game plan. These are the things I used to think about when I was a hedge fund manager on days like today. Days like these are facts of life. There are going to be sessions where doom is in the air and it all goes wrong, except drugs and utilities, of course. Sessions where you can't believe that you own some of the worst stocks. And to add insult to injury, they had the guts to bring CoreWeave public. CoreWeave? How are they doing this to us? Worst possible timing for an AI infrastructure IPO. To all of us, I say, look, just take a deep breath. Everything that's happening is happening because the government's gotten involved in business in a way that Wall Street simply can't believe. We haven't seen tariffs like this since right before the Great Depression. Things are happening so fast that we can't even figure out what we'll do if car prices jump right anywhere from, say, 4,000 to 20,000. But how about this? What happens after the tariffs go into effect on April 2nd? Liberation Day, when the president says he'll announce a new round of import duties. What happens April 3rd? Will everything be as bad as it is today? No, people sold today to get in position for April 2nd. If the president would be more constructive or thoughtful about what should be tariffed and by how much, we'll rewind the tape and say, why the heck didn't we buy something last Friday when that CoreWeave deal was imploding? I know it feels too risky to own anything right now, but that's often a prelude to wishing you bought something up when the smoke clears. Now, that may sound insanely positive, and as I said at the top of the show, I'm not all that sanguine. But keep in mind, we don't have major structural problems in the country. We don't have runaway inflation either. Although this morning we had a series of personal consumption expenditure numbers, the ones the Fed takes seriously. They were too hot for the Fed to justify cutting rates, at least for now. I know the tariffs only make things worse on the inflation front. But man, if we get a weak unemployment report next Friday, the Fed will have to cut whether they like it or not, because the tariffs, as harsh as they are, must be considered artificial, and they will depress spending. Looming always, though, are two thoughts. First, in 4 days, we will know the worst case, and I'm expecting the worst case when it comes to trade, at least. In the end, though, our government can only tariff so much. This president won't cause a recession just for the sake of recession. That doesn't make any sense. Second, tariffs will definitely hurt American business and make things go up in price. But that's also something that the stock market can ultimately adjust to. In other words, this too shall pass. And if you decide to get out now, you're liable to miss some very big gains down the road, even though you're taking a beating for the moment. Getting out now is also not a strategy. To put it a different way, there's a man who lives in the White House and, of course, Mar-a-Lago, and he has the ability to turn this entire market around with a single Truth Social post. The damage he's doing may not matter to him right now, but I think there will come a point when he recognizes that it's time to stop and our former allies are beaten to a pulp and we can move on. It won't be hard because after Wednesday, the big tariffing will at last be behind us. There will only be so much foreign commerce left to wreck. Only so many prices that can still be raised. At the pace Trump works, that probably won't be that far away. As much as I fear the destruction being wrought, and it is a lot of destruction, I fear missing the rally after the tariffing is over. And it may be sooner than you can execute a strategy to get out of your entire portfolio on Monday. At that point, let me ask you, do you think that you can get back in before the rebound? See, I know the truth. And the answer is no. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.